Right, well, what do you make of this? I mean, it's quite something, isn't it? It's a major concern for the markets, but apparently we shouldn't be that concerned.
Well, inflation's a problem in a number of markets around Asia. In India, it's at a 3-year high. We've got inflation there almost at 10%. So in China, it's a little bit less, 5.5%.
But is it really 5.5%?
Well, if you look within that, if you look at, say, food price inflation, that's close to 12%. So the big battle for the Chinese authorities is, can they bring inflation down? Can they stop some of the rampant property market speculation without causing a sharp slowdown in growth? And I think the risks of a hard landing are increasing, but I think on balance, I think the odds are still in favour of them being able to bring sort of inflation down. But if you look at where we are at the moment, repo rates are at 4-year highs now. We've had interest rates, short-term interest rates raised 4 times.
The Shanghai Interbank offered rate keeps on climbing. It was something like 9% the other morning when it was fixed, so quite something. I mean, what is that telling you? That's factoring in, rampant inflation, also looking ahead, a hard landing too.
And it's also telling you that, banks are holding cash. This is going to cause problems for some of the SMEs.
Right, so does that mean that we're also got the spectre of a credit crunch as well, because people are not trusting each other's balance sheets?
Well, the question is this a short-term phenomenon? Will the banks over the next few months slowly start to sort of release cash again, and will, some of the SMEs be able to get the funding that they require? If they can't, then yes, there is a risk of an increasing sort of credit crunch, particularly for some of the more indebted SMEs. So certainly I think the risks of a hard landing are increasing. But as I say, I think on balance, I think we will be able to see sort of growth pick up again maybe later on in the year.
Yeah, let's also just take a look from the market's perspective what they are pricing in with regards to China at the moment. And I'm just talking about equity markets here.
Well, at the moment, we're being buffeted by a whole range of global sort of cross currents. So we have the Greek sovereign debt crisis, we have a slowdown in US growth, we have the withdrawal of QE2, which is a large part of that liquidity has flowed into emerging markets, particularly in Asia, and also into commodity markets. So the big question is, as we withdraw that liquidity support, and in particular as we see a slowdown in US growth, is that going to have a big impact on emerging markets out here? And I think in the short term it's going to be difficult for the emerging markets to make much headway.
Now, what kind of impact do you think Greece is having now? Do you think we've now coming towards the end game of this right now, and that's more or less priced in? Because I guess attention may well turn after July the 2nd towards the US and their debt ceiling.
Well, I think at the moment Greece is going for the staggering on option. It will probably get funding to allow it to pay the bills for a few more months. But I think at the end of the day, the problem is Greece is insolvent. This is not a liquidity problem.
So that's the perception, isn't it? That's the misperception, some would argue, about what's going on. This is not... Everybody knows that Greece is broke. You could argue that. But it's about liquidity. It's about the banks and limiting their exposure, all the debtors.
Well, the main aim is to avoid a disorderly default, and defaults come in many shapes and sizes, but if there was a disorderly default, then there is a real risk that we could have contagion into other European economies, particularly Portugal, particularly Ireland, and the big fear of course is Spain, which is a very large European economy. But even if Greece was to implement the austerity measures that it's talking about, even if it raised the 50 billion euros in privatisations that it's promising, and you have to remember it hasn't done a single one yet.
Well, there's the appetite out there at the moment as well.
It's still going to have, by 2014, debt which is 150% of GDP. So it really does have a solvency problem. So I think the issue is just when does it default and how exactly does it do it. But the aim at the moment is to try and get Greece to muddle through and allow the banks time to shore up their balance sheets, try and get some of the Greek bonds that are mainly contained within about 25 European banks, offer their balance sheets to give the banks time to be able to deal with this.